All right, good morning. My name is Jevin Gibb. I'm the Director of Research and Economic Development at the Metro Hartford Alliance. Thank you for joining us this morning to talk about PPP forgiveness and overall financial planning to kind of get through the crisis, get to the new normal. If you've been following the news this morning, you've seen that Congress approved changes to PPP. So we're going to talk about that a little bit, but we're also going to acknowledge and give a disclaimer that things are changing. What we're seeing is very positive for businesses, and our panelists will get into that today. With that, I'm going to go ahead and end the polling that we opened with, and I will share it with the group so that you can see who we have in the meeting. The majority work for companies between 6 and 20 people. Many will apply for PPP forgiveness themselves. So from there, just a brief disclaimer, any comments made in this communication are not intended as authoritative. This is kind of best practices that we're trying to gather. If you want, authoritative advice, please, retain paid counsel. Some quick housekeeping before we get started. All participants are muted. Please ask questions using the Q&A module, not the chat. We're going to allow for questions periodically throughout the webinar. We're not going to save it until the end like we have in the past. So please don't hesitate to ask questions as they come up, and we'll try to stop to make space to answer those questions. I apologize for the typo because questions will not be answered at the end. Video and slides will be posted to preparedhartford.com and LinkedIn. We will send a follow-up email with additional information and links. That's especially important now because we'll talk about the changes that Congress passed in that follow-up email. And please write in the chat box if you can't see or hear something. Today's goal is twofold, primarily to help you prepare to apply for PPP forgiveness, but we also want to help with overall financial planning. I want to thank our panelists. Today, we've got Drew Andrews. He's managing partner and CEO at Whittlesey. Based out of Hartford, Whittlesey is one of the largest regional CPA and IT consulting firms in New England. Drew has more than 30 years of public accounting and consulting experience and was elected firm managing partner in 2008. He has extensive experience with financial institutions, nonprofit organizations, and closely held companies. Brian Kerrigan is advisory partner at Whittlesey. He has more than 20 years of tax consulting and business advisory services experience. He has extensive experience with mergers and acquisitions of both closely held and publicly held companies. James Barger is market president of KeyBank for Connecticut and Massachusetts. KeyBank helped secure more than $8.5 billion in loans for nearly 40,000 small businesses through the PPP. That volume is comparable to around 10 years of typical production in just a few short weeks. Over 65% of KeyBank's loans were to businesses with revenue under $3 million. Funding will support more than 3 million employees around the country. Denis Horrigan is co-founder and partner at Connecticut Wealth Management. He has over 30 years of financial planning experience working with business owners, executives, and their families. He served on the Connecticut Wealth Management Investment Committee, or SERVS, and is actively involved on the board of several local not-for-profit organizations, and is often interviewed and quoted by local and national media. I'm excited to have this panel together to give you practical advice to try to help you through this process. For today's agenda, we'll start with an overview of PPP forgiveness. Then we'll talk about what your bank needs, how to gather those requirements. We'll also talk about some of the other programs that are in the works, and we'll finish by discussing overall financial planning. So from there, I'll hand it off to Drew and Brian to talk about an overview of PPP forgiveness.
Thank you, Jevin. This is Drew. First, as we start with the overview, and our first slide has changed since last night when the new act was passed. So the PPP loans will be forgiven if funds are used to keep employees on payroll. Now, the 8 weeks and 75% spent on payroll costs has changed to 24 weeks and 60%. Just to take one step back, this bill passed both the House and Senate yesterday. The Senate passed it, and now it just needs to be approved by the president, and we believe that's going to happen. and also some things have changed in the second bullet, reduction in workforce or salaries and rehire dates. It will still impact the loan forgiveness, but there are some exceptions to that. And then the unforgiven piece of the loan will be eligible for loan repayment. Now, I think they're changing that to 5 years at 1% instead of 2 years. So payroll costs now must be at least 60% of the full loan amount to be eligible for full forgiveness. Costs can be paid or incurred over a period of 24 weeks for eligible for forgiveness. And the start is still the loan disbursement date, and we believe it'll still go through the last pay period of the 24 weeks. So the allowable costs will include health insurance premiums, retirement contributions paid by the employee, vacation time, family, medical, or sick leave, and state and local employee payroll taxes. Wages, salaries, commissions will still be included, and hazard pay and bonuses, which was a big issue earlier on, is eligible for forgiveness. Salaries, we believe, are still capped at $100,000 over the covered period, which would be 24 weeks, which would change obviously to $15,385 to about I think would probably be 45,000 and change, maybe 46,000 over 24 weeks for business owners and self-employed individuals and self-employed partners. Now, that's our interpretation today. After we just read the act this morning, I read it at about 5:30 this morning. So what's going to happen also with everything, just to put a little caveat behind some of the changes, is once the bill gets signed by the president, it'll go to the Treasury, who will determine the rules and come out with some frequently asked questions and then probably a new loan forgiveness application sometime, hopefully next week, and then we'll have a better feel for some of this stuff, like the cap at $15,385 is one that kind of I'm still scratching my head on a little bit. Now non-payroll costs are going to be 40% of the loan. That would include rent or lease payments, utility payments, and mortgage interest payments during the covered period. So that would be 24 weeks of rent, utilities, or mortgage interest. I still believe that they must be in place as of February 15, 2020. I don't think that has changed. And would be paid during the 24-week covered period or incurred during the covered period and paid before the next regular billing date. And prepayment of non-payroll costs is not allowed. Full-time equivalents are based on a 40-hour work week, and employees working less than 40 hours per week will be measured at their hours divided by 40 hours per week. You have a reference period to compare to. So the start of whether you have a reduction in forgiveness is either January 1, 2020 through February 29, 2020, or February 15, 2019 through June 30, 2019. And borrowers would reduce these levels beginning February 15, 2020 and ending April 26, 2020, and restore the levels by now I think it is December 31st, 2020 to their full-time equivalent level in the February 15, 2020 pay period are exempt from a loan reduction based on full-time equivalents. Now the change that also occurred is if during the period beginning on February 15, 2020 and ending on December 31, 2020, if you're able to document an inability to rehire the individuals who were employees on February 15, 2020, and an inability to hire similarly qualified employees for the unfilled positions on or before December 31, 2020, or able to document your inability to return to the same level of business activity as your business was operating on or before February 15, 2020 due to basically a government shutdown, this requirement is you're exempt from this requirement, the way I'm reading this. So that means you would not have to go through this calculation for reduction of the loan forgiveness on full-time equivalents. Brian, you want to pick up here?
Yeah, so we'll start by talking about some technical issues with respect to the loan application and the forgiveness application. Next slide, please, Jamal. So as Drew hit upon, when we wrote the slides, we were anticipating that a bill would pass the House and Senate. It had passed the House, now it has passed the Senate. So it's the first major change is it's going to increase the covered period from 8 weeks to 24 weeks. I think the hope here is that it establishes, it makes it more likely that these loans will be forgiven, and it allows for some flexibility in industries such as restaurants, where they're just not able to be open, and they didn't see the real need to bring people back and pay them to do nothing when their business wasn't necessarily going to return right away. So that's an important piece, increasing the covered period from 8 weeks to 24 weeks. I think, as Drew mentioned, there's some exclusions from the full-time equivalency if you can't bring everybody back based on your business circumstances, and that was an issue that we were concerned about with the expansion of the 8 to 24 weeks. The loan term will be extended from 2 years to 5 years, so you'll have more to, if you don't have it all forgiven, and this is probably going to be an exception rather than the rule going forward, you would have a 1% loan over 5 years. We're going to relax the 75-25 split. Now payroll costs have to be at least 60% of your total forgivable costs, leaving 40% for your rent, your utilities, and interest on other mortgage obligations. Last of all, the extension of the rehiring deadline. So we had talked about June 30th being a safe harbor. You needed to bring everybody back by June 30th. And if that was over and above your February 15th number, you basically would fit in within the safe harbor. That's been extended to December 31st, 2020. So I don't think much has changed here in terms of audits. Loans that are greater than $2 million will be audited. Loans that are under $2 million are subject to audit. So the SBA has an option of looking at those loans. In either case, you want to keep your loan documentation for 6 years in case the Treasury or the SBA decides to audit it. The big issue that we had early on was, we had a lot of public companies go out and get PPP money, and Congress sort of reacted fairly quickly, saying that's not what we intended. So, the certification that borrowers had to make is that the current economic uncertainty makes the loan request necessary to support the ongoing operations of the application, and they do not have any other available sources of liquidity. And that other sources of liquidity gave us some issues early on, because we weren't sure if you had a line of credit, if that meant you had other sources of liquidity, if you had very wealthy owners, if that was another source of liquidity. But they basically came out with a safe harbor provision that says that if your loan is less than $2 million, you'll be considered to have made the certification in good faith. If it's greater than $2 billion, then you have to look at, whether you've actually made the certification, whether you met the facts for making the certification. So, they sort of eased up the requirement that you have to consider other liquidity sources with the loans under $2 million.
Thanks, Drew and Brian. Two quick questions. First, a question about whether the slides will be emailed after the presentation. Yes, and they'll be posted, and we'll get updated slides with information about the new legislation posted to our preparedhartford.com website. Another question, is there any clarification as to what is included in transportation costs?
Not yet. We're hoping to get that soon.
Great. So when we get that, what we'll try to do, and I think I know who submitted that question. I'll reach out personally to make sure that we extend that information. All right. So from there, because we have a packed schedule, let's move along to James to talk about what the bank will need from borrowers to get forgiveness.
Well, thank you. So this first slide talks about the process of how to receive forgiveness on your PPP loan. You start off, not surprisingly, by completing the PPP loan forgiveness application form 3508. KeyBank's intention, and this is in process, is to have a digital version of that application to simplify completion of the application and then processing of the forgiveness downstream. In addition to completing the application, you'll need to provide supporting documentation that supports the numbers and calculations that are in the loan forgiveness application. And I'll show that in the next slide. Regarding that forgiveness amount, the borrower is responsible for making that calculation on the application. You then submit your application to your lender, and the lender has up to 60 days from the receipt of, I've bolded here, a complete application and a complete set of documents. Because if it's not complete, the lender will get back with the PPP borrower and request the additional information necessary to get complete information. That 60-day clock doesn't start ticking until there's a complete submission of the application and the supporting documents. So it's important that you complete the application fully and provide documents supporting each of the aspects of the information that you provided in the application. Once the bank has completed its review and concurs with the forgiveness amount calculated by the borrower, it submits the application and the supporting documents to the SBA. The SBA then has 90 days, up to 90 days, to process and approve it. And if the SBA approves it within 90 days, probably shorter than that, but up to 90 days, it will submit the forgiveness amount to the lender, and then the lender pays off the obligation the borrower had, hence the forgiveness. If you had an EIDL advance, be aware that the SBA will deduct that dollar for dollar from the amount of the forgiveness that was calculated. Any amount not forgiven is payable as a loan, which was one of the documents that you signed when you got the loan, the note, which has a 2-year maturity and a 1% fixed rate. And obviously that 6-month payment deferment, that has changed under the new legislation. New PPP loans, instead of the 2-year maturity, will have a 5-year maturity. Next slide, please. So this slide lists the information that lenders will require you to submit. First and foremost, of course, is the PPP loan forgiveness application. And then each of the items below this support various aspects of the PPP loan. The first bullet point is, documentation demonstrating the cash compensation and non-cash benefits that were paid during the covered, or if you choose the alternative payroll covered period. This is, it could include bank account statements. A lot of small businesses have third-party payroll processor. It could include reports from them. It would include payroll tax filings that you report quarterly. That's typically IRS Form 941. State quarterly business reports that are filed are important as well, primarily because that's where the unemployment insurance tax is shown, and that is deductible that can be added back to forgiveness, so that it's important that that information be provided. You're also going to want other payroll expenses that need to be documented under this bullet point are, of course, health insurance and retirement benefits that you pay to employees. So account statements or receipts and canceled checks for health insurance portion that the company paid and retirement benefits that the company paid would be all documents under the first bullet point. The second bullet point, documentation showing the average number of FTEs during the chosen reference period. This is relevant because the amount that is forgiven can be reduced if the number of FTEs has dropped during the period of the PPP loan. And there are a bunch of rules about adding them back, but you need to be able to demonstrate what the FTEs were during the reference period. And, that would include, payroll tax filings, reports, typically IRS Form 941 that would show the FTE numbers. And if you're wondering about how do I show the FTE numbers during the covered period or the alternative payroll covered period, the forms that you provided for the cash compensation would cover that on the FTE count as well. Also, you're going to want to be able to demonstrate that now at December 31st is a relevant date because you have the opportunity to add FTE back by that date. You're going to want to show documentation showing interest on mortgages, whether for real estate or personal property during the covered period. And that could be account statements from your mortgage or personal property loan provider, or it could be canceled checks and receipts. You're also going to want to show similar information regarding those mortgages at February 15th, 2020. That's not because that's part of the period, covered period or the alternative payroll covered period. That's because there's a requirement that those mortgages have been in place by the 15th of February. So you need to provide some documentation demonstrating that. You're going to want to show documentation showing any rent or lease payments that you're claiming to reduce the increased forgiveness during the covered period. And that could be, account statements for, rent or lease, or it could be, canceled checks, receipts. You're also going to want to show documentation of the existence of those rent and lease obligations at the 15th of February, because it's required to have been in place by the 15th of February. You're going to want to show documentation showing utility payments during the covered period. This could be account statements from your utility provider, or it could be, canceled checks, receipts. You're also going to want to show documentation showing the existence of that utility obligation at the 15th of February, again, because it's a requirement that that service had been in place by 15th of February. Now, the next three bullets pertain to adjustments to what you otherwise would reduce the forgiveness amount by because of a reduction of FTE or a reduction in salary or hourly wage rate. So you're going to want to demonstrate, I referred to this before. It's now the relevant date isn't June 30th. The relevant date is December 31st, based on the new law that's going to the president to be signed. But you're going to want to demonstrate, the rehiring of employees and restoration of salaries and wage levels by December 31st in order to avoid a reduction in the forgiveness amount. You're also able to not reduce FTE by people that you would have hired who declined. So you're going to want to show documentation of your good faith offers to rehire those folks and that they were declined. And furthermore, you don't have to take a hit to FTE for certain employee headcount reductions, such as if you hired folks for good cause voluntary resignations, or if they voluntarily requested a reduced schedule. So in all those cases, you'll need to provide documentation to support that number that you would show in the PPP loan forgiveness application. That is, I know that's a lot of information, but that is what your bank will be looking for. Thank you.
Thanks, Jim. And we have a lot of questions coming out of that section. I'll just roll through them and throw them out to the group. First, are security systems classified under utilities?
I don't know that we necessarily have an answer for that. I have not seen anything that says they are included, but I also have not seen anything that says they're not included. I mean, I think if you were going to include them, you'd have to try to get under the utility piece.
Yeah, just to add to that, I think they came out with what is included, and the presumption would be, and that wasn't part of it. So the presumption would be they are included.
Great. With regard to the 60% on payroll, I was reading there is now a cliff and no longer partial forgiveness if a borrower does not meet that 60% ratio. Is that true? Is there no longer partial forgiveness?
That's the way the bill reads, but it may be interpreted differently by the Treasury. So I would say yes today, maybe something different tomorrow or next week when they come out with some more guidance on that.
All right.
That was absolutely a concern of some of the senators. This bill had originated in the House, and some senators were concerned about this potential cliff effect related to payroll. And some of them sought assurance that Treasury and SBA would deal with that through their final rulemaking process. So as Drew said, as of today, yes, but I wouldn't be surprised if it changed going forward.
Great. Can a company opt to forego the forgiveness and keep it as a loan at 1% over 5 years?
Yes, I believe you can. I would say it's probably, yeah. Exactly.
Well, the answer to that is yes. What triggers forgiveness is the submission of an application to the bank for forgiveness. You do not have to request forgiveness.
Great. And then we have two questions asking about documentation for so what documentation required for one person entity for payroll, and another question saying what documentation will self-employed individuals need to supply. Drew and Brian, do we want to just go to your part of the presentation where that might be covered?
Sure. I don't know if we cover that specifically, but I think you'd have to show some sort of a financial statement, not a financial statement in the formal sense, but like a QuickBooks P&L or something of that nature.
All right. So at this point, let's go into Drew and Brian talking a little bit about how companies are going to pull all of this information that their banks need.
Okay, so for most, if you have a payroll service or company such as an ADP or a Paychex or anyone else, they will probably supply most of the information that you're going to need that Jim was discussing a little bit before. In other words, they will probably, most of them have already come up with a report that they're going to have to adjust now, which was going to give you an 8-week summary of your salary. So I think that would be the first step, go with them. And companies that are doing their own internal payroll, they can generate a report off their internal system that they're using. Most people tend to use QuickBooks, and that can generate a report that would give you the payroll that should be sufficient to document it. You'd also need to maintain your records, and for I think it's 6 years. So IRS forms 941s would also need to be maintained by you as the company, and cancel checks and invoices. From what I think Jim went really deep into what would be required on every category. So, and then I think one thing we recommended as which is probably the most prudent thing we're going to say today, is talk to your advisors, your accountants. We'd like to think you talk to your accountants first, but your accountants, lawyers, financial advisors, bankers, and don't rush into making decisions that might changed, especially in the next week or so as things start to get more defined with the rules. So I would say, if I was to advise someone today, I would say sit tight and let's wait and see what happens in the next few days, and then let's determine the strategy.
One other thing, just back to the self-employment piece of it. I mean, if you're a true sole proprietor and you have no employees, you're not going to have any payroll costs. Your payroll costs are going to be effectively either the monthly amount, a monthly figure based on your 2019 income, or 15,385. So you're really probably going to be able to use canceled checks to document the fact that the owner has been paid during the covered period.
Thanks, Brian. Did I have any extra slides for that? I don't think so. So let me go back to some questions. One was, is there still money left in the Paycheck Protection Program? And I think the accompanying part there is, if you haven't applied, should you think about it?
Well, yes. As of a week ago, the second round of the PPP, $310 billion was authorized for that. As of about a week ago, 175 billion of that had been allocated, which as of a week ago means there was 135 billion remaining. So the answer to the question is yes, there are resources remaining in the PPP program. It's open to applications. The SBA is actively encouraging banks to encourage borrowers to participate in the program. I mean, should you participate in the program? Well, that's your personal choice, but there are many benefits of the program. You saw how popular it was. First round was, 349 billion went away in a week or two, and we're 175 billion into the second round. So it's been a very popular program for many reasons, not the least of which is what we're talking about today, the forgiveness aspect of it. It's a personal decision, but there are many, many reasons for getting a PPP loan that are favorable.
And the extension of the period to 24 weeks was really meant to deal with some of the industries that weren't able to open up or have been shut down. So I think the hope is that this change will make it more appealing to your restaurant type clients, and that they may be more likely to go for the loan and hopefully use up the rest of the money in the second round of funding.
Jim, maybe a question to you, but also to the rest of the group. At the Alliance, we heard a lot of people talking about how difficult it was to get through the initial application for PPP. Can you talk about how common it was to struggle with the process, and then thinking about applying for forgiveness, your expectation about, the amount of back and forth it's going to require with your bank to get that done?
Sure. I mean, I have a lot of personal experience in that. So, you read earlier on the presentation that KeyBank processed about 40,000 PPP loans in a matter of weeks, totaling $8.5 billion, which was the equivalent of volume that typically on the SBA side, KeyBank would process in 10 years. We did it in a couple of weeks. So as you can imagine, it was an all hands on deck process. So I documented loans. I was somewhere between 2 and 3 dozen loans. I documented. I was on the phone talking to borrowers. I heard many of the things that the borrowers that we're talking about today with forgiveness, like, if it was a pizza shop or a salon. I had a long discussion with the owner of a salon or a lawn service, I can't operate. The government has put us in lockdown. I've got 8 weeks to incur expenses for forgiveness, but I can't operate because we're in lockdown. And guess what? I can't hire people back right now because the unemployment benefits are so good. So I heard that story over and over again. So the changes, I'm going field here a little bit. So the changes to forgiveness that are being shown right now, to a certain extent, are to address those issues, and these are all very positive changes. The process was difficult in many cases. I think my personal experience regarding the difficulty of the process was entity documents. So, you know, the typical loan that I processed, the people I was talking to, these were loans of $10, $20, $30,000. And, you know, so as a matter of our process, we're asking for articles of organization, bylaws, borrowers' resolutions. And I found out that the vast majority of the people that I was talking to, well, first of all, they weren't sure what the articles of organization were, let alone, you know, where do I find them? So there's a big educational process. It caused a lot of small business owners who don't specialize in legal and accounting issues to become experts in legal and accounting issues overnight with our help. So it was a struggle, it was a challenge, but I have to say personally, for me, it was very rewarding to be working hand in hand with these people to get them the money that they needed to continue to operate. So I would say yes, it was a difficult process. Entity documentation was by far the most difficult issue. There were issues caused by, it was such a drastic amount of workload in such a short period of time that not all the systems that were put up in place out of the gate in order to process all these loan requests worked that well. You know, us trying to send applications up to the SBA, borrowers trying to get their information to us, there were difficulties. I feel confident that we've had enough time to digest the best practices, the lessons learned from the application process and the document preparation process, that we've learned a lot about how to streamline the forgiveness process. So I am confident that the forgiveness process will be smoother than the application process was. It's not as rushed a process. Not everybody's going to apply for forgiveness at the way everyone was trying to apply for a loan at the same time. So I'm confident that the forgiveness process will be smoother than what the application process was.
No, I think, Kevin, just for a moment, I think what Jim and his colleagues did and the other bankers is, I don't think they get enough credit for what they had to face. I mean, they had to fly without a flight plan, and it was just unbelievable, the volume of people that were knocking on their doors overnight. So kudos to all the bankers in Connecticut that helped out all the small business owners. The other thing I would suggest is if you haven't yet applied, one key to this entire pandemic, and it really sheds light on how we face other challenges in our business world, is you need to have some flexibility. And flexibility is super important and super valuable. If you haven't yet applied, and maybe it's because you don't have your articles of incorporation, et cetera, get that stuff in order. And I would go apply for the money. Even if you don't get forgiveness, 1% over 5 years, that's still a pretty good rate. But give yourself some flexibility, and I would go apply for that loan.
And building on that, we have a question. Can a company submit a second request for additional PPP funding? Maybe if for the first one they didn't get the amount that they had expected or hoped for?
There is a way to do that in limited circumstances. The general answer is no, you can't go back for a second round of funding, but there was some issues going back and forth early on about whether you could include owners up to 100,000 in your calculation of total payroll costs, and the guidance really wasn't inclusive one way or the other. So, but if you did have that situation where you effectively you didn't get the owner compensation up to 100 grand, you may be able to go back for another round of funding, but it is contingent upon whether the SBA, whether the bank has submitted certain forms to the SBA.
So it sounds like the answer is talk to your bank. It's possible that maybe
it's limited. It's pretty limited. You have to fit a narrow band of facts for it to apply to you. You know, I think, but the idea that you can kind of go back a second time is very limited.
Great. And the one thing I want to point out before we move to the next topic, talking about the other programs that are out there right now, for a lot of small businesses, if you can afford payroll services, if you can, afford an accountant, those people will help you through this process. If you cannot, there is still the SBDC, there's SCORE, there are other services that we've highlighted throughout this process that are free. You have to schedule appointments to get with them, and we'll put that contact information on the website for people who maybe don't have the resources necessary, especially given the cash crunch that many businesses are facing.
Hey, Brian, can I ask you and Drew a question? Actually, Jim, you too. So we had a lot of business owners that when the first round of funding came out, there was such a kind of gold rush for it. And some people took loans that then they started to feel may have been inappropriate, and they actually gave their money back.
Mm-hmm.
We have some business owner clients that gave their money back. Now that there appears to be enough money for, I dare say, everybody, would they qualify as one of those organizations that could go back in and look for a loan?
The answer is specifically, I don't think we know, but I think fundamentally, I would think you could. If you gave the money back, you could probably reapply since you didn't take the money. I don't know, Jim, that might be something for you to think about.
Yeah, I'm not sure about that, but certainly we experienced the same thing where we had borrowers that either it had been approved and just before it was funded they wanted to pull back, or just after it was funded they wanted to prepay it. And remember, there was a window for prepaying after you received it that would be considered in good faith and all that. So we did have, not a lot of it, but we did have some of it.
And I think part of it is it was very difficult to figure out whether you had an economic uncertainty in the beginning. And, did you have these other available sources of liquidity that could help you get through the COVID-19 situation? So we actually had clients who gave the money back, but in retrospect, they probably didn't have to, because the $2 million safe harbor came out. And if you're under a $2 million loan, it was at least presumed that you had an economic need for the funds. So,
well, I think there were really two primary reasons that people gave money back. One was, look, they weren't sure upon when they look back at the attestations that they made, they weren't sure that they necessarily, met the requirements. So as an abundance of caution, they pulled the money back. That was one reason. And, if you're going to try to come back and, reapply after you already determined that you didn't think that you met the intent of the program, and now you do, I don't know, that's a little bit questionable. But the other reason that people gave their money back was that they weren't convinced that they would qualify for forgiveness, for reasons that I touched upon before. Like there was a government shutdown; they couldn't operate over the next 8 weeks. How am I going to get forgiveness if I'm prevented? I'm precluded from operating. And do I just want to hire people back? Well, I can't, because they're getting better. They're getting all this unemployment. I can't even hire them back, even though I don't have anything for them to do. So that was another reason people gave some money back. Now that's a different situation. Now you've got a 24-week period, and the lockup, the economy starting to open up again. That issue is not as great an issue as some of our borrowers were facing initially after the first round. So that might be a separate situation. Bottom line is I don't know the answer. I'm just making kind of general statements about the two different reasons that I saw people pull money back.
Yeah, I would totally agree with you, Jim. I think the second scenario is probably a valid reason to go forward and try to get a loan. The first scenario, unless circumstances have changed or you determine that you misinterpreted the circumstances, then I think it would be more difficult to justify it.
Gotcha. So one quick question before we move on to talking about the Main Street Lending Program. When is it required to start paying back? Looking at my loan, I don't see the 1% interest starting to accrue.
You have a deferral of the interest for now. I think it's till the end for a year.
So that's why it's not
It
going
would
to
only get tacked on the unforgiven piece once that's determined, and it'd be retroactive to day one of when you receive the disbursement.
Great,
And
thank
the
you.
payment of the principal, well, whatever is forgiven is forgiven, but if there's an amount that isn't forgiven, if it's an existing PPP loan, it matures in 2 years. So the full principal amount is due in 2 years.
5 years.
What's that?
5 years now.
Oh, it is. Oh, the 2-year terms are automatically extended to 5?
Yeah.
Okay.
But to Jim's point, I think the way I've seen the loan documentation, at least with some of the banks, is that you would be required to pay back principal and interest during the 18 months, not just the principal at the end of the loan.
All right, so from there, let's do a quick coverage of the Main Street Lending Program as another option that might be coming down the road for companies.
Sure. Specifically, the Main Street Lending Program, I was a little bit reticent about talking about this because we have a couple minutes, and this is an entire topic in and of itself. So the CARES Act that authorized the PPP also authorized the Main Street Lending Program. The intent of the PPP was to support employment among small businesses and to get the money out rapidly and to have a forgiveness component of it. The intent of the Main Street Lending Program, this is not an SBA program, it's through the Fed, and this is for larger companies. It's to support larger companies, it's to support employment at larger companies, and it does not have a forgiveness component. And the debt is not guaranteed by the government. So what that means is that the banks have to underwrite this deal. So there's an underwriting decision that the banks make. It is funded to the tune of about $600 billion, so it's a large program. It's still in process. One of our bankers here in Connecticut is very actively involved in this program within KeyBank. And it is anticipated that, there are all kinds of issues between the banks and the Fed right now, the participation agreements associated with it that are being structured and negotiated. So the program will probably be ready officially in a couple of weeks, but then the Fed has to make pronouncements and implementation announcements, and the banks have to digest it. So, you're probably looking that it's available sometime in the end of June-ish or later. The intent of the program is to support U.S. companies negatively affected by COVID and maintain U.S. employment. That is the same as the PPP. I say eligibility generally because eligibility is a complex issue, so I just pulled out the main sound bites here. It's U.S. for-profit companies, got to be domiciled in the U.S., less than 15,000 employees or less than $5 billion of revenue. And another important criteria is that based on their 2019 performance, they would be rated at pass credit. It is, as I mentioned earlier, subject to bank underwriting. So there's an application, which is not complete yet. It's still being built by the government, but there'll be an application that you submit to the banks, and then you'll have to submit additional information to the banks in order for them to do their complete underwriting. There are, the Main Street Lending Program actually consists of 3 different loans, 3 different types of loans, and each one of them is really targeted at a different use, a different need, different size companies, different situations. And it's way beyond the scope of this conversation to go into that. An important aspect of the Main Street Lending Program is that it's a bank government participation. So regardless of which 3 loan it is, if a loan is approved by the bank, the loan will be booked, and then the majority of the loan will be participated to a special purpose vehicle set up by the government, and the government will fund it. Depending on which 3 loans you have, the bank will keep either 5 or 15%, with the remainder held by the government. Each of the 3 loans has a minimum and maximum size. 2 of these loans, the minimum size is $500,000, the maximum is $25 million. The other one, the minimum is 10 million and the maximum is 200 million. The concept of EBITDA, which is kind of a wonky accounting banking term for a type of profitability. 2019 EBITDA is a key component in determining the eligibility or the size of the loan that a borrower can get. Basically, you multiply EBITDA by a certain number and subtract existing debt, and the difference is what the borrower is available for. And then there are, the terms of the loans, the rate's LIBOR plus 300. There are fees. Unlike the PPP, the borrower pays fees. There's a 1-year payment deferral. Amortization is different depending on which of the 3 loans you have, but the amortization is over the remaining 3 years after the 1-year payment deferral. Collateral depends on which of the 3 loans you have. The repayment of existing debt, that's an important concept for the Main Street Lending Program in general. Proceeds of the Main Street Lending Program cannot be used to prepay existing debt. It's intended to grow the capacity of the companies in order to continue to provide employment and operations during difficult times caused by COVID-19. In some cases, in some loans, existing debt can be paid off. So that's just a brief summary of the Main Street Lending Program. Not larger companies. Key aspect here is that it's focused on larger companies. So probably the majority of the people on this call would not be applying for a Main Street Lending Program loan.
Thanks, Jim, and I appreciate you going over that. It's something that a lot of people have asked about, so we wanted to do just a high-level overview to increase awareness. So from there, I'm going to toss it over to Denis to talk about kind of overall financial planning going forward in whatever the new normal turns out to be.
Great, thanks, Kevin. Appreciate it. I do want to just take 1 second just to acknowledge what everybody on this call and across our state has been going through the last few months. It's been very difficult, very challenging on many different fronts. We don't take that lightly, and to be able to share some information, hopefully it's helpful for folks. So the first thing that we always talk to our clients about, and most of our clients are business owners and executives, the first thing we talk with them about is always starting to craft a plan, is to build a plan out. For a business owner, it's kind of like a pro forma. It's what Drew and Brian would look at as a pro forma for a business. We want to do a pro forma for an individual and their business, really, because we sit at the intersection of personal financial planning and their business planning. So we suggest that people sit down, do a pro forma, check out what your expenses are going to be for the rest of your life. Honestly, buying cars, buying second homes, putting kids through college, weddings, everything. And then you start to build in scenarios. Some of those scenarios might be bad markets. They happen. Bad economic environments, bad business, the inability to sell your business for what you thought you were going to, because the plan cannot be completely reliant on the sale of a business, because as we have seen, people's plans to sell a business can be tossed to the wind if the economy takes a turn for the worst. So to build a plan out, to provide you some visibility as to what would happen if the markets go south, if the economy goes south, et cetera. That's really important. Run those scenarios, be ready to revisit those plans over and over and over again so that you're prepared for these sorts of environments. But a few takeaways, and I know we're late in time here, Jevin, so a few key takeaways. One is liquidity. We spoke about this earlier. As a business owner, as an individual, you need to be flexible in times like these and build in some flexibility to your plan. Right now, we just talked about Main Street Loan Program. We talked about PPP, the EIDL. There have been a lot of programs that have been made available to business owners and individuals to provide some liquidity. In addition to those, you might want to make sure you have a line of credit with the bank. Make sure that you have that safety valve as a business and personally. You might want to consider having a home equity line of credit. If you didn't already have one, you might want to get it. It's basically a safety valve. These safety valves are very helpful, but you need to have like a mean uncle that can look over your shoulder and make sure that you're not abusing them, that you're not overspending your home equity line of credit for kind of silly reasons. And then there's an ability right now, an opportunity still to refinance debt that you might have personally. Rates are still very, very low. They're not as low as they were, but they're still, historically extremely low to refinance any debt that you might have. So that's the first thing, is liquidity. I think that's key. The second one is taxes. I think my colleagues on this call would agree that the debt that our government necessarily, I would suggest, has taken on is probably going to result in higher tax rates in the future. I think we will look back at the tax rates that we are living in right now, whether it's capital gains, income, or even estate. We're going to look back at these and think of them as very favorable. So I think future environment is you're going to probably have higher tax rates. Based on that, I think as a result of your survey, Jevin, it was 10% of the businesses that you surveyed at the beginning of this call. Business is good, so don't forget that. There are some businesses that are thriving. I had a call with a business owner client a couple of weeks ago. He can't hire enough employees, cannot find enough employees. Some businesses are killing it right now. If you are a business that is doing very well, this might be the year that you decide to make a donation to a donor advised fund. Donor advised funds are a super helpful tool that can help you reduce your tax liability. And let's face it, nonprofits really need the help right now. So donor advised fund, if your business is doing well, might be a great solution. Tax loss harvesting, if you have investments, as many of us do, that have gone down in value, you may want to consider selling that investment and harvesting the loss. Put it in your pocket. You can use it on your taxes. You can use it on your taxes actually in another way too, and that is you may also want to sell your gainers, sell your winners. You can sell a winner, use that gain that you're realizing, offset it with a loss that you realize. You can buy that investment back if you want and reestablish a higher cost basis. There's no 31-day wash sale rule, by the way, if you sell a gainer and buy it back. So that's an idea. Also, if your business is good. If your business has been rough, as many people have, many folks don't realize this, but there's a capital gains rate of 0% if your income is very low. If you're in that bracket, sorry that you're in that bracket, but you might want to utilize that bracket right now, and you may want to actually realize some gains. Realize gains at a 0% tax rate. That's very, very rare, and I think it's going to get even more rare. You may, again, if your business is doing well, you may want to consider converting a traditional IRA to a Roth IRA. When you do that, you take an IRA and you move it to a Roth. That process creates taxable income. Well, if your taxable income this year is very low, this would be a good year to do it. And also, considering that tax rates in the future are going to be higher, we think, again, it's another argument to do a Roth conversion. So that's, if your business is bad, Roth conversion, take advantage of 0% capital gains rates. And the estate planning part of this can get pretty complicated, and I don't want to spend too much time on it, but this could be a very good year to do some gifting, to get assets out of your estate. You can do some gifting at some pretty heavy discounts, whether your investments have gone down or your business has been discounted. You might want to consider using what's called a GRAT, and I know that's a super technical term. It's a grantor retained annuity trust. It's a really nice way to get future growth out of your estate. Give you an example. If you had $100,000 of Apple stock and you put that into a GRAT, a 2-year GRAT, you have to take $50,000 back after year 1, $50,000 back after year 2. Any growth in that Apple stock over those 2 years sits in that GRAT, forever avoiding estate taxes. It stays out of your estate. It's a really nice tool. You can use high growth investments, might be shares of your business. Going back to the beginning, making sure you have a plan. A big part of that plan is your succession, the succession of your business. ESOP, internal transition, outside sale. You got to do the work. You got to do the homework early to prepare for that eventuality. So in a limited amount of time, Jevin, I think I got most of what I wanted to say in, and you got 45 seconds.
Thank you. No, that's great. We stayed pretty close to schedule, but I want to thank all of our panelists today: Drew, Brian, James, and Denis. I think we got through most of the questions. Dennis, quick question to you. What is the name of the estate plan again? GRAT, isn't it?
GRAT,
GRAT?
G-R-A-T, Grantor Retained Annuity Trust, GRAT.
Great. Because we answered that, there are no, actually, we've got a couple questions that we need to go back to get information for people. We'll post that information online after the webinar. Questions and a recording of this webinar will be posted at preparedhartford.com. If you want to reach out to any of the panelists, their contact information is here, and we will share this slide deck so that you can get that information in the future. As a reminder, the Alliance has ongoing events. We've got 2 events coming up, a Break the Ice luncheon on June 10th from 12 to 1, and Alliance Coffee Chats on Thursday, June 18 from 9 to 10 a.m. For more information on these events, go to metrohartford.com. And with that, I'd like to thank everybody for attending. Again, special thanks to the panelists. If you have any questions, please feel free to reach out to me, the Alliance, or to any of the panelists today. So thank you very much.
Thanks, Kevin.
Thank you.
Thank you.
Thank you.